Well, in this video, I'm going to talk about how to generate a regular paycheck from your retirement accounts. And specifically, we're talking about your registered retirement income fund. Now, I use the word paycheck very intentionally. Obviously, this is not a paycheck in the normal way that we think about it, right? You're working for a living and your employer pays you income in the form of a paycheck. But I think the analogy is really important, and I'll talk about that in a second. So in this video, we're going to be very practical. We're just going to talk about what do you need to think about before you talk to your financial institution to set up a regular income or paycheck from your portfolio. So we'll go over some of the key considerations there. What about frequency? What about withholding tax on your accounts? What should you consider there? And then finally, how do you structure your account to generate consistent monthly income in the form of not just income, but in many people's minds, kind of a paycheck, a regular income to replace the paycheck that they received when they were working. I use the word paycheck very intentionally because psychologically for many clients, what I've found is that ideally they want to be budgeting and managing their cash flow much like they were when they were working full-time and getting a paycheck. The money's coming in, source deductions have happened, CRA's gotten their piece, whatever's left in the account, then they budget accordingly, and they just use what they've used in the past successfully. They've got their basic expenses, their periodic expenses, their discretionary expenses, and they just manage their cash flow accordingly. The only difference is now you're employing yourself. You're generating your monthly paycheck or income from your RRIF account, and we'll talk specifically about the RRIF in the context of this video today, but you could apply some of these principles to other accounts that you have as well. So for those of you that don't need to do this right away, because you've got defined benefit pension plans or you've got other sources of income, this may not be super relevant, but at some point you will be forced to take income from your RRIF account. So a lot of the ideas here will be relevant for you at some point. So now you're transitioning into retirement. You want to generate a monthly income. What are some of the things you need to begin doing at a practical level to start that process? So let's take a look at the main steps you need to consider, some of the questions you need to begin asking yourself. By the way, if we haven't met before, my name is Shaun Humphries. Our team's been doing retirement income planning for 3 decades. And if you don't want to miss future content like this, make sure you hit subscribe as well. Go to the show notes. You can get free resources on retirement planning and learn more about our retirement income planning services. Okay, let's walk through the process of setting up the RRIF account. You've made the decision that you're going to set it up and you're going to start taking monthly income from the account. So the first thing is you need to think through the kinds of questions that you'll be asked by your financial institution. Even before they get into questions about how much income you're going to take, they're going to ask you some other questions around your overall financial position. Sometimes people are wondering why the advisor or institution does that. Well, it's viewed as a significant milestone or change in financial position. So whenever you go to a new account agreement, like a RRIF, you'll be asked questions like your risk temperament. Are you a low risk, medium risk, high risk investor? What about your overall balance sheet? You will be asked information about your assets with other institutions, any real estate holdings, just a basic profile of your current financial position. They'll ask you questions about the timeline for the portfolio in addition to your risk temperament. So don't be surprised by those questions. They're going to be asked of you, and you want to begin thinking about some of your answers for those questions. That's just a normal part of the process. So as well, with the RRIF account, anything you have in the RSP account normally can be transferred directly on an in-kind basis to the RRIF account. There's no requirement for you to sell any financial assets. There's no tax triggered on the transfer. The money just shifts across to the RRIF account. Now, as many of you already know, the year in which you have to do this is in your 71st year, the year in which you turn 71, and then the first payment has to come out in your 72nd year. But for most people, they end up setting up a RRIF account well before then as a way of producing monthly regular income. Now, the other thing that you should try to be clear on, particularly if you're going to start taking income right away, is your instructions around pre-tax income payments from the account. So money has to flow out of the RRIF account on a regular basis, and then also the tax withholding. So we'll talk about the tax withholding amounts, and I'll go through a couple of calculators on our website that you can use to begin estimating what the basic tax amount should be on those payments. Now, it's important to be mindful of just some background information about the RRIF account. The reason that we go through this process before age 71 to set up monthly income is that the RSP account is not set up mechanically to pay a regular income. So you can put monthly contributions into an RSP, but you cannot do systematic payments from an RSP account to your bank account. To do that, you need to have a RRIF account established, and then from that RRIF account, you can start making systematic payments. Now, those payments can be monthly, they can be biweekly, they can be twice monthly. Again, your institution may have some restrictions on this, but for the most part, many institutions will give this frequency to you. Now, again, you don't have to opt for, payments every month. You can go semi-annual, you can go quarterly, you can go annually. So for those people who do not need the monthly paycheck, they may just say, listen, pay out once a year. Here's when I want it. It's a time of the year when I have additional expenses for travel or going down south, that kind of thing. But for the purposes of our discussion, you just want to match up the frequency. And for many people, they'll choose a frequency that lined up closely with how they were getting their monthly paycheck from their employer. So that's the next piece. And then finally, statutory tax payment amounts. We'll cover that off in a bit of detail in this presentation. So like I said at the beginning of the video, I wanted to make this really practical. And one of the ways I'll try to do that is just reference the calculators from our website. And so you can access the calculators. Just go to the show notes. There's links back to the website, and you can use these same calculators in your own planning. So this first calculator is a RRIF payment calculator, just looking at the RRIF minimum repayments or what would happen to the portfolio if you did a fixed payment. So it's just a great quick calculator you can use to do that. So in this example, we've got a $200,000 RRIF account. We're starting payments at age 65. We're looking at showing the value out to age 90. Use spouse's age. I said no, but of course, if you've got a partner, you can say yes, and you would use that if your partner is younger than you. That means that the statutory requirement on the RRIF minimum could be lower. Payments will start in the first year at age 65, and we're using a RRIF minimum. Like I said, you can use a fixed payment or minimum. We're using the minimum. So the program will just go through and show you each year what the requirement is each year as a payment and what percentage of the portfolio. And it'll show you the ending value each year in this analysis out to age 90. And then you can print off a PDF if you want from this report. So again, for those of you who just want to do a quick calculation, what's the RRIF minimum requirement? Or if I take a fixed amount out, what would that be? Now, there's one really important planning principle around the RRIF accounts prior to age 71. Age 71, everything has to be moved into a RRIF account from the RSP accounts. Prior to that, you've got lots of flexibility. So it's very common for people to have both RSP accounts and RRIF accounts prior to age 71. And so one of the things that people will often do is they'll move sufficient money from their RSP account to a RRIF account. Let's say it's 3 years worth of income payments. But they'll leave the balance of the dollars in their RSP account. Now, why would you do that? Well, sometimes people have periodic income, contract income. They may not want to make a full commitment to push everything into the RRIF account, because if they do that, then they're required to take the RRIF minimum on a larger balance. So let's say you had, $1 million in your RRIF account, and you retire and you push everything into the RRIF account. Now you've got a much larger RRIF minimum requirement than if you just put, let's say, a couple $100,000 in a RRIF account to fund payments over the next few years. Now, you can go back the other way. I mean, if you put $1 million into the RRIF and then you realize that was a mistake, you can back out of that prior to the age of 71 and push money back into the RSP if you wanted to do that. But it's very common for people to sort of have satellite accounts, their RRIF account, which is sort of the engine of that monthly paycheck on a regular basis. Now, let's look at another calculator that could be very helpful for you. Now, this next calculator is called Will the Money Last, or really how long will the money last for? And this is a great sort of quick calculator to say, well, I'll put money in, here's my spend rate, how long will the portfolio last for? So you can apply this to your RRIF account. So you look at $500,000 in these two scenarios, scenario 1 and 2, 5% return assumption. And scenario 1, we're taking $20,000 a year pre-tax, and scenario 2, $40,000 per year pre-tax. And we're indexing those payments by 2% per year. And so it'll do a calculator, it'll give you a report that shows you year-by-year income and balances. But you can see scenario 1 is going to last 44 years. And scenario 2 would last 16 years. So you can go back and forth in these numbers just to see what a drawdown strategy would look like and how long the portfolio would last for. Now, again, one caveat. Really, at the end of the day, the best way of modeling these income payments is in the context of your full financial plans. As we'll talk about in a minute, there are tax questions, there's income splitting with your spouse, there's all kinds of other factors that should be taken into account when you're looking at a drawdown strategy from your RRIF accounts to generate that monthly paycheck. But this is a good sort of quick way of just doing a calculation to see what the impact will be on the portfolio. So I'd encourage you to go to those calculators and use them to give you some quick ideas on the impacts of different drawdowns from the accounts. Okay, let's look at the CRA tax requirements or remittances that have to be made. Obviously relevant before we get into a discussion on producing that monthly paycheck from your portfolio. So on payments up to $5,000, the remittance amount at source is 10%, $5,001 to $15,000 is 20%, and over $15,000 is 30%. Now, on your RRIF minimums, which we've talked about, there's not a statutory requirement to hold back tax. So from a financial planning standpoint, it theoretically makes sense not to hold back any tax, receive that payment. Now you've got the money to invest and work with. CRA doesn't have it, and they won't get it until you file your taxes and make your remittance at that point. So theoretically, that's the right approach. What I find practically is that doesn't work for most clients. Most clients default to, you know what, Shaun, I just don't want any surprises at tax time. So could you calculate what my effective tax rate is for every dollar I pull out of my RRIF accounts for the year? Let's hold back that amount. And so when I get to tax time, I'm not having to stroke out any larger checks. So this is more a comfort level thing. I don't think that's wrong. It may not be the right financial consideration. Probably the differences between the two strategies are not significant financially. And if it just gives you more peace of mind that you're just keeping current with your tax remittances to CRA, then do it that way. But over and above the RRIF minimums, these are the statutory requirements. Let's take a look at the calculator on our website, and you can use a calculator to sort of figure out what your effective tax rate is or your average tax rate to give you a starting point for what your remittances should be for every dollar you pull out of the RRIF account. Now, this tax calculator, again, there's a link in the show notes so you can get to it. It's just a very quick little calculator to be a starting point for you. This is not designed to replace talking to your accountant necessarily or your financial planner who have much more sophisticated tools to do the tax calculation. So keep in mind, often the tax calculations can be a function of other sources of income coming in. Maybe you've got CPP benefits, superannuation. If you have a partner, maybe there's some income splitting opportunities. So it's a more complex calculation than what I'm showing you here potentially. But this is just a good starting point. So let's say this client, they live in Ontario and they have no other sources of income. They're going to pull $45,000 from their RRIF account. That's their goal, to replace their paycheck of $37.50 a month pre-tax. They're going to pull out $45,000 per year from their RRIF account. Again, if you go back to one of the other calculators, you can demonstrate what the impact on the portfolio is if you took out $45,000 per year. But they've arrived at this number. So the marginal tax rate is 20% federal provincial, tax payable 62.62, and so they need to basically, if you look at the effective rate or the average tax rate, it's 13.92%, rounded up to 14%. So then they can give their financial institution direction that on every dollar that comes out of the account, push 14% to CRA. So at the end of the year, you're going to get a T4 RRIF with the payment of $45,000. And then in that T4 RRIF, you're going to show a remittance of $62.62. Okay? So you can apply that to your own assumptions. What are you going to take from the RRIF account? Calculate what the remittance is. Like I said, the one caveat is I'd recommend that before you do a final assessment on remittances, have your financial planner or your accountant do a more detailed calculation to take into account, your personal exemptions, tax credits, donations, all the different pieces to your T1 tax filing. That's ideal, but this will be giving you a quick little calculation as you're doing some of the number crunching on your own about how you're going to handle your RRIF account. Okay, we're almost there in terms of getting that monthly paycheck from your RRIF account to your bank account. You've looked at the calculators. You understand now what the impact will be on your portfolio using different monthly drawdown rates. You've made some assumptions about the return that you need to achieve on your accounts. And you've also looked at the required tax remittances. So you know the monthly amount pre-tax and the monthly amount net of taxes. Now that's really important information for this next step, which is the portfolio design. So your investment portfolio is going to be a function of your risk temperament. It's going to be a function of your overall financial position, and it's going to be a function of the overall returns that you've assumed that you would like to achieve on your portfolio. So all those things play into the mix. So I'm going to cover off some important strategy ideas around designing on a portfolio that will get that income into your accounts every month. One really important caveat: it's really important that if you're unsure about any of these factors, make sure you talk to your financial advisor. They can do these calculations. What they'll do is they'll take into account if you've got a spouse, any tax planning opportunities. If you have other buckets of money, that will impact how much you take out of the RRIF account. So keep in mind, we're looking at this decision in isolation. How do I create a paycheck from the RRIF account? But before you make final decisions, sit down with a professional to map out what needs to be done in the context of your overall plan. If you haven't had that done, go to the show notes. There's a link back to our website. You can find out more about our services, and you can arrange a complimentary call to learn more and have some of your questions addressed. So when it comes to generating that monthly paycheck from your RRIF account, we need to structure the portfolio to do that very thing. As well, we need to structure the portfolio to generate the return goals over the longer term that you're trying to achieve. Your portfolio will likely have three different mandates. It'll have money in high yield savings or GICs, very cautious, conservative, safe harbor investments, and we'll talk about how to use those investments in a second. Well, it may have a balanced investment mandate or a pure growth or stock and mandate in the portfolio. And like I said, the mix of these investments will be a function of your goals financially for cash flow, your investment temperament, and your overall financial position. So let's talk about the high yield savings or cash position. That's often referred to as a cash wedge in the portfolio. So the circle is your overall portfolio, but the cash wedge is set aside to have money at the ready to generate cash flow for you. So the overall portfolio is more likely invested in growth to balanced investment accounts. And then this cash wedge in the red here is in high yield savings, GICs, T-bills. In my example here, we're pulling $25,000 pre-tax out of the RRIF account every year. So view that part of your portfolio as a piece that's non-negotiable. It's like an insurance policy. It's out of the market. So if you're generating income and there's a down market that happens, you're not worrying about selling assets at a bad time to generate that income. Now, once we have this cash wedge in place, then you want to look at your balanced or growth portfolio. This chart just gives you some historical numbers over the past, and it tells you that the more conservative you are with your investment mix, the less the return. The more growth assets you have in the portfolio, the higher return, and there's more risk attached. So if I looked at this balanced portfolio here, 40% income, 60% stocks, the long-term averages on that portfolio are about 7.4% compounded returns. However, in any given year, the swing rate was minus 13% to plus 36%. And that's why you need to have a mix of cash equivalents and growth investments in your portfolio in case you hit years of minus 13%. Now, what happens is you're not going to get the 7.4% on the whole portfolio. If I look at a portfolio that has, let's say, $100,000, let's say I have a $600,000 portfolio, I put $100,000 in cash equivalents, safe harbor assets. The rest is maybe in a balanced portfolio. I'm looking at returns that would be in the range of 5.7% long term as an average return. So you need to make sure you're weighting the average return consistent with how much you have in the cash wedge position. Well, let's bring this all together by going back to our client that wanted $45,000 per year of income. That was a pre-tax income need, and so that's $3,750 per month. They did some tax calculations using the calculator. They had $569 per month that would be remitted to CRA, and then the net amount going into the bank account would be $31.81 per month. They looked at the budget and they thought they could make their basic expenses work based on that. That goes to the bank account, and then at the end of the year, they receive a T-slip. The T-slip is going to have their gross income of $3,750 annualized, which is $45,000, plus all tax costs remitted through the year. Now, many of you might be watching this video and going, I'm following the bouncing ball. Like I get at a high level, Shaun, the basic strategies, but at the end of the day, I have no idea how to actually implement or execute on the strategy. And my current advisor is not doing this kind of work for me. So again, just go to the show notes. There's a link back to our website. You can set up a complimentary call to learn more about what we do. We do this all the time. We do the retirement income plan, and they would do a structured investment memo to tie that investment portfolio to your plan to make sure that you're doing it tax effectively and also make sure you don't have more life than money. So there's a whole bunch of pieces that tie into that calculation. Be happy to have a conversation with you. So once your paycheck is set up, there's some really important follow-up things that you need to be doing on a regular basis. So first of all, review the status of the income wedge, initiate profit taking to replenish the cash wedge balance. So if you're going to use the wedge account periodically for income payments, it does need to be reconstituted, so to speak. And that means you need to put in your calendar a systematic way of just rebalancing and taking profits when they're on the table. The profits may not always be there. With a balanced or growth portfolio, you could have out of a 10-year cycle, 2 to 3 years that are very subpar. But you want to make sure that you're doing that consistent profit taking. Number two, review the asset mix of your core investment portfolio. So it often will need to be repositioned. It can't be static. There might be some planning that you need to do within the portfolio to make sure it's consistently monitored. And then at the end of the day, year-end tax planning. So we've talked about the monthly paycheck idea, but surrounding that will be some additional tax considerations. It could be RSP meltdown, where you might have a monthly income going to you to supplement your cash flow as a paycheck, but then you can initiate some additional redemptions potentially from your portfolio to exploit your marginal tax rate or your tax bracket. And that doesn't have to be a payment to your bank account. That can be an in-kind transfer that moves from, let's say, your RRIF account into your tax-free savings account or into your non-registered account where you pay the tax, but you've done the homework where it would make sense for you to absorb that tax early to melt down the RSP account or the RRIF account because you've done that proactive planning. And as you go about this planning, there's some other considerations just to be mindful of. First of all, age 65, if you pay out $2,000 from your RRIF account, it qualifies for the pension income tax credit if you don't have any other income that qualifies. If you look at age 65 as well, if you have no superannuation plan, up to 50% of your RRIF payments can be split with your partner if you have a partner for tax purposes. And the RRIF payment calculation, can you use the spouse's age in the calculation? Of course you can. So there could be some situations where on an account you want to reduce the requirements at age 70, going into your 72nd year. And in that case, if you have a younger spouse, using their age would make sense in that context. And finally, there's no withholding tax required on RRIF minimum payments. But like I said, a lot of people default to having some tax held back. They just don't like getting surprises at the end of the year. Well, you've learned a lot of considerations around getting that paycheck into your bank account. And if you like this video, you'll like the one that's on your screen right now.